$82.26. That's what silver closed at on March 3rd, 2026. And if you think that number is just another data point on a chart, you haven't been watching what's happening underneath the surface of this market. Because right now, as of this morning, March 6th, 2026, we are sitting at what may be the single most compressed spring in the history of the silver market. The price you're seeing on your screen is not the real story. The real story is a 64% collapse in COMEX registered inventory since April of 2020. The real story is 52.63 million ounces of silver being demanded for physical delivery in March alone, against just 86 million ounces of registered stock. The real story is the CME Group hiking silver futures maintenance margins by 36% in a single day, which is the financial equivalent of kicking a support beam out from under a building that's already swaying. I need you to stay with me through this entire video, because by the end of it, you'll understand exactly why that $82.26 price point is either an enormous gift or an enormous trap. And which one it is depends entirely on what you know that most people don't. Let me start by establishing what we actually know as documented, verifiable fact. Not speculation, not forums, not Reddit. Official CME Group delivery reports and warehouse data. Treasury filings. JP Morgan Research, Euronews, Fortune, Al Jazeera. All of these sources point to the same set of extraordinary conditions. On February 27, 2026, which was first notice day for the March silver futures contract, 10,526 delivery contracts were served. That translates to 52.63 million ounces of silver on a single day, demanded for physical pickup. And the total registered silver available at COMEX to meet that demand, according to CME warehouse data, 86.13 million ounces. That's not comfortable. That is a coverage ratio so thin that any analyst who's been tracking this exchange for 30 years will tell you they've never seen anything like it during a primary delivery month. And March is the primary delivery month. This is the big one. Now here's what makes this even more extraordinary. We just came off February 2026, which, according to official CME delivery reports, was already the highest February delivery volume in modern COMEX history. 5,036 contracts delivered, 25.18 million ounces, in what is historically a quiet month. And before that, January 2026 set its own record, 49.4 million ounces delivered. Compare that to January of prior years, when the typical delivery was between 1 and 5 million ounces. We're talking about a 7 to 10 times increase in physical takedown in a traditionally quiet month. Something structural changed in this market, and most retail buyers have no idea. For those of you who aren't subscribed yet, I want to take a quick second. My analytics show that roughly 3 out of 4 of you watching right now haven't hit that subscribe button. If this kind of evidence-based breakdown is cutting through the noise for you, I genuinely appreciate the subscription. It tells me who the serious community is, it helps my channel, and it helps the algorithm put this analysis in front of people who actually need it. Now let's get back to the numbers, because I want to show you the historical pattern that makes this moment so familiar, in the most alarming possible way. Here's a framework that most commentators miss entirely. The silver market has gone through what I call delivery stress cycles 3 times in modern financial history, and each time the setup looks almost identical to what we're seeing right now. The first was in 1979 and 1980. Nelson and William Hunt accumulated somewhere between 100 million and 200 million ounces of silver, effectively cornering the physical market. Silver ran from roughly $6 an ounce to $49.45 by January 17, 1980. Then, in March 1980, and notice that month, March, the exchange changed the rules mid-game, imposing position limits and forcing the Hunts to sell. Silver collapsed 50% in 4 days. But here's the part nobody talks about. In the weeks before the rule change, the delivery stress indicators looked almost exactly like what we're seeing today. Registered inventory depleted, delivery rates spiking, paper versus physical divergence at historic extremes. The second notable stress event came in March 2021 during the retail-driven silver squeeze, when the Wall Street bets community piled into SLV. Physical premiums on silver rounds and bars spiked to 30% above spot. The paper price barely moved, but try buying a 1-ounce coin at spot price during that week. You couldn't. And now we have 2026, and I want to argue to you that this cycle is different from both of those, because the demand isn't speculative. It is industrial. It is strategic. and it is being driven by forces that don't go away when the exchange hikes margins. Let me explain what's driving this physical demand, because if you understand this, you understand why the $82.26 price point we're watching right now may look absurd in hindsight. Silver was officially added to the U.S. critical minerals list in late 2025. That's a regulatory designation that signals something profound. The government has formally acknowledged that silver is not optional for the economy. It's not jewelry. It's not coin collecting. It's solar panels. It's electric vehicle batteries. It's AI server cooling systems. It's the conductive paste printed onto every photovoltaic cell on the planet. Meta announced in January 2026 that it signed 3 major nuclear power deals totaling 6.6 gigawatts of contracted capacity through 2035. Microsoft, Amazon, and Google signed over 10 gigawatts of long-term nuclear power agreements. Every one of those data centers, every one of those reactors uses silver in ways that are irreversible, meaning once it's consumed in those applications, it doesn't come back as recyclable bullion. It's gone. And industrial users are not speculators. They don't roll their futures contracts. They take delivery. That's why the delivery numbers have exploded. Now stick with me, because this next part is where it gets genuinely alarming. I said 86.13 million ounces of registered COMEX inventory as of late February. But that headline number is misleading, and here's why. COMEX inventory is split into 2 categories. Registered stock means silver that's been formally warranted and is immediately deliverable. Eligible stock meets the standards but hasn't been formally made available. When delivery pressure hits, exchange operators try to convert eligible to registered, but that process isn't instantaneous, and it depends on who owns the metal. Here's what we know from data going back to October 2025. COMEX registered silver stocks peaked at approximately 167.7 million ounces in October. By early February 2026, they had fallen to roughly 103.5 million ounces. That's a 38% drop in 4 months. And COMEX registered inventory has fallen 64% from its April 2020 peak of 240 million ounces. Think about that trajectory, from 240 million ounces down to 86 million ounces. While delivery demand is running at the highest rate in exchange history. It's like a bathtub draining at triple the normal speed while someone turned the faucet down to a trickle. But wait, because here's where it really gets interesting. The Shanghai Futures Exchange, China's primary silver trading venue, is showing its own inventory stress simultaneously. Shanghai silver stocks fell from 559 tons in November 2025 to 318.5 tons by February 2026. That's a 43% decline in 3 months. Now, when both COMEX in New York and the Shanghai Futures Exchange in China are simultaneously bleeding registered silver inventory, that's not a regional story. That's a global physical squeeze. And the lease rate data backs this up. In normal market conditions, the 1-month silver lease rate sits around 0.3% to 0.5%. It's boring. Nobody talks about it. But by January 2026, that lease rate had exploded to around 8%. There were reports of intraday peaks as high as 34.9% in October 2025 from Japan Bullion Market Association data. Why does lease rate matter? Because when it spikes, it means the institutions that lend silver out for a return are charging a premium, which signals they can't easily source the metal. It's a canary in a very deep, very dark mine. Let's talk about the price action itself, because the volatility we've seen over the last 6 weeks tells a story that most commentators are framing completely backwards. Silver touched an all-time high of $121.62 per ounce on January 29, 2026. Then, in a single day, it collapsed 31%. Which, according to Euronews, was the biggest percentage drop for the metal since March of 1980. The same month the Hunts got wiped out, by the way. Silver went from $121 to roughly $81 in a matter of hours, with intraday lows touching the mid-70s. The mainstream narrative called this a speculative blow-off, with U.S. Treasury Secretary Scott Bessent publicly attributing the extreme swings to Chinese traders. And then the CME Group, the owner of COMEX, announced a 36% hike in silver futures maintenance margins. What does a margin hike do? It forces anyone who can't post more collateral to liquidate their position. It floods the market with sellers. The price goes down. And if you're a large financial institution with access to massive leverage, a margin-induced crash is a beautiful opportunity to pick up cheap long positions, or cheap physical metal, at distressed prices. Now here's the question I want you to sit with. After the January 29th crash, did the delivery pressure resolve? Did the physical stress in the market go away? According to CME warehouse data and the delivery reports, no. February's delivery numbers came in as the highest February in modern history. March's first notice demand, 52.63 million ounces, exceeded anything the market had seen at that stage of a delivery cycle. The inventory continued to drain. The only thing that changed was the paper price. The physical reality did not change. This is the disconnect that defines whether we're watching a real price discovery mechanism or a managed narrative. The paper market says one thing, the empty vaults say another. One of them is lying. Or more precisely, one of them is temporary. According to an analysis by financial data site Jinlo on Substack, citing official CME delivery reports, in just 60 days, from January through late February, COMEX delivered 74.38 million ounces of silver. That's 86.4% of the current registered inventory in just 2 months. 2 months. And managed money speculative positioning had simultaneously collapsed 77.72% year over year. In February 2025, managed money held 54,415 contracts. By February 2026, that had dropped to 12,121 contracts. So speculative longs were being flushed out while physical deliveries were at record highs. That tells you exactly who's on the other side of this trade. It's not retail investors. It's not Reddit squeezes. It's industrial users and institutional players with manufacturing lines that can't run without silver. And they are taking the metal off the exchange as fast as the rules allow. Here's something I want to make sure you understand about the paper versus physical dynamic, because this is where the real argument lives. As of March 4th, 2026, there were 6.5 times more paper silver claims outstanding than there was deliverable registered metal in COMEX vaults. The coverage ratio, meaning what percentage of outstanding paper claims could be satisfied with registered inventory, was sitting below the 15% threshold that analysts historically define as stress territory. Below 15% is considered rare. It's associated with delivery squeezes. We're there. A previous analysis of March 2026 open interest put the notional value of all outstanding silver futures contracts at approximately 500 to 528 million ounces. If even 25% of participants stand for delivery, a conservative assumption given the recent pattern, COMEX would need to come up with 125 to 132 million ounces, against 86 million registered. You don't need to be a math genius to see the problem. Now I want to present you with what I consider the most important single piece of evidence in this entire analysis. And I want to be precise about the source, because I am not asking you to take my word for it. I'm asking you to look at the JP Morgan Global Research Report on silver pricing, which you can find directly at jpmorgan.com. Greg Shearer, JP Morgan's head of precious and base metals research, said this: if tariffs come back, and the Section 232 report left open the optionality of the government eventually moving back to tariffs, we will see this whole trade of moving metal back to New York likely revive and create an environment where actual physical liquidity outside of the U.S. begins to get tight. He's describing the exact mechanism that caused the January spike. Tariff uncertainty triggered an arbitrage. Move silver to New York before tariffs make it more expensive to do so. That metal is now sitting in COMEX vaults, or rather, it was sitting there, and it's draining fast. JP Morgan, for what it's worth, projected silver would average $81 per ounce in 2026. We've already been above 90, touched 121, and crashed back toward the low 80s. We're at the number JP Morgan called as the annual average, in early March, with 10 months still to go. And JP Morgan isn't alone. After the late January crash, analysts at Julius Baer said that investors would likely pick up their purchases of gold and silver once they believe the market has stabilized. Their fundamental thesis? The US dollar should continue to depreciate, and central banks should increase their holdings. The central bank gold accumulation story, which is run alongside silver's rally, is documented and real. Central banks bought gold at record rates through 2022, 2023, 2024, and into 2025. When central banks buy gold, they aren't trend followers. They're restructuring reserve portfolios. That is not a trade that reverses in a quarter. Now let me show you where the Shanghai divergence fits into all of this, because this is the part of the story most Western commentators miss entirely. As COMEX registered inventory declined, silver was flowing to London at extraordinary speed. In the first week of January 2026, COMEX registered inventory fell by 18 million ounces, while deliveries totaled 33.45 million ounces, meaning the balance had to come from conversions of eligible stock or existing allocations. Why was metal flowing to London? Because the LBMA, the London Bullion Market Association, which is the heart of global spot silver trading, had its own shortage. Silver lease rates spiked to 34.9% on October 9, 2025, with intraday peaks at 39.2%, according to Japan Bullion Market Association data. High lease rates create arbitrage. Source silver from New York, transport it to London, pocket the spread, which drains New York. And when both exchanges are draining simultaneously, as they are now, the global picture becomes very clear. There is a genuine physical supply deficit, and it's getting worse, not better. The LBMA, by the way, had a notable credibility problem when it was revealed that in 2021 they had overstated silver holdings by approximately 3,300 tons, which was later explained as a calculation error. But that kind of error doesn't exactly inspire confidence in exchange-reported inventory figures. So let's talk about what's happened to price over the past few days and what it means for the next 48 hours, because that's what the title of this video promises, and I'm going to deliver on it. On March 5th, 2026, silver fell nearly 9%, struggling to hold the $82 support level. The catalysts were specific and documented. First, robust U.S. economic data reignited the higher-for-longer interest rate narrative, pushing the U.S. dollar index to a 5-week high of 98.0. A stronger dollar makes dollar-priced commodities more expensive for foreign buyers, which reduces demand. Second, the nomination of Kevin Warsh as the new Federal Reserve Chair, known as the Warsh shock in financial media, sent a hawkish signal through the entire commodities complex. Warsh has an inflation hawk reputation. Markets pricing in an aggressive rate stance reduces the appeal of non-yielding assets like silver. Third, the CME Group announced that 36% margin hike on silver futures, forcing a wave of liquidations from over-leveraged players. What followed was described as a flash crash scenario during the London session. Silver cascaded lower. And here's where we are right now on March 6th. Approximately $82 to $83 per ounce, down from $94 on March 2nd, down from $121 on January 29th, down 32% from the all-time high in 5 weeks. But, and this is the critical word, down in paper price only. The physical reality hasn't changed. This is the inflection point. This is the moment I want you to really think about. The inventory hasn't been replenished, the delivery demand hasn't slowed, the industrial users haven't stopped needing silver for solar panels and EV components and AI infrastructure, the lease rates are still elevated, the Shanghai exchange is still drained. China has been reclassifying silver internally as a strategic material and restricting exports, a story that got almost no mainstream coverage but is documented in market analysis from Trading Key and other commodity research firms. The paper price has crashed. The physical market conditions have not. And when you have a 32% paper crash against a physical market that's running hot, what you typically get, historically, is an overreaction in the paper market that eventually reverts. The question is always the timing. And here's where I want to be very direct with you. I am not a financial advisor. I am showing you documented data. What you do with it is your decision. But if you study the 1980 cycle, the 2011 cycle, and even the 2021 mini cycle, you'll notice that extreme, margin-driven liquidation events in silver are not the end of the story. They are typically part of the story. Let me make this personal and practical, because abstract data only takes you so far. Here's what this means for real people in 5 specific situations. First, if you currently own physical silver you bought above $90 per ounce, your position is underwater on a paper basis, but the physical premium structure hasn't collapsed. Premiums on physical silver, the difference between what you pay for a coin or bar versus the spot price, tend to widen when paper prices fall sharply, which means your metal's real-world bid is partly cushioned. That's not the same as don't worry, but it's important context. Second, if you're thinking about buying silver for the first time in this environment, we are currently sitting roughly 32% below the all-time high. JP Morgan projected $81 as the full-year average. We're right there. Every single month of 2025 saw higher COMEX deliveries than the same month of 2024. Industrial demand is structural, not cyclical. That doesn't mean prices go straight up. March 5th proved they don't. But the long-term supply-demand picture hasn't changed. Third, if you own silver ETFs like SLV or miners through something like the Global X Silver Miners ETF, you need to understand that these had massive outflows on March 5th, according to financial data reports, as hot money rotated back toward US dollars and treasuries. Paper silver is not the same as physical silver. When delivery stress hits, paper prices can be pushed in directions that don't reflect physical reality for extended periods. Fourth, if you're watching silver in the context of the broader precious metals complex, gold is near $5,200 per ounce as of this recording. The gold to silver ratio is historically extreme, meaning silver is cheap relative to gold even at current prices. When that ratio normalizes historically, Silver tends to outperform gold in percentage terms. Fifth, if you're simply trying to understand whether the financial system itself is under stress, the fact that COMEX delivered 86.4% of its registered inventory in 60 days, while simultaneously maintaining that everything is operating normally, that's an extraordinary claim. Watch the March delivery data as it comes in over the next 2 to 3 weeks. That is the real stress test. I want to address the counter-argument honestly, because I think intellectual honesty is what keeps this channel credible. GoldSilver.com published a detailed breakdown arguing that the COMEX default fears are overstated, that open interest doesn't equal delivery demand, that most contracts roll over or settle financially, and that the 98% delivery rate figure being circulated was based on a denominator calculation error. Those are fair points. The mechanics of futures markets do mean that headline open interest significantly overstates likely physical demand. If you're hearing the most extreme versions of the COMEX default imminent narrative, the kind that says the whole financial system collapses in days, I'd encourage you to read the GoldSilver.com breakdown and form your own view. What I am telling you is this: even after adjusting for normal roll rates, the delivery pressure in January, February, and the opening of March 2026 is historically unprecedented. The inventory is genuinely depleted relative to historical norms. The lease rates tell a real story, and a 36% margin hike mid-cycle is not a routine administrative update. Something real is happening. The magnitude of what that something is, that's the open question. Now here's where I bring this full circle. I opened this video with $82.26. That's the price silver hit on March 3rd, 2026, following a 2-day crash after touching $94 on Monday. The current price on March 6th is in the same neighborhood, roughly $82 to $83. And the forward path over the next 48 hours is being shaped by 3 specific factors in real time. First, how many March delivery contracts ultimately stand for physical versus rolling to May? That number is being updated daily by the CME, and you can track it yourself at cmegroup.com in the delivery reports section. Second, whether the Federal Reserve, under its current chair or under Kevin Warsh if confirmed, signals any softening on rates. The markets are currently pricing in roughly 60 basis points of Fed easing by year end. Any shift in that expectation moves precious metals significantly. Third, the geopolitical factor. Reports as of March 4th indicated Iranian operatives made contact to discuss terms around ending the Middle East military conflict, according to a New York Times report, which sent gold and silver higher as the dollar fell. If that situation escalates instead of de-escalating, safe haven flows into silver could be rapid and significant. Silver's all-time high, reached on January 29th, 2026, was $121.62. Today we're at roughly $82. The crash was real. The margin hike was real. The dollar strengthening was real. But the COMEX registered inventory is still 64% below its 2020 peak. The Shanghai Exchange is still depleted. Industrial demand from solar, EVs, nuclear, and AI infrastructure is not optional demand. It's demand written into multi-decade capital expenditure commitments by the largest technology companies in the world. The lease rates are still elevated. The March delivery cycle is the most stress-tested in exchange history. And the silver-to-gold ratio is at levels that historically precede significant silver outperformance. Every major cycle in silver's modern history has had a moment exactly like this one. A brutal paper crash, institutional liquidation, headlines saying the bubble is over, and then, quietly, the physical market reasserting itself. Spain in the 1500s hoarded silver from South America and watched their empire rise, and then collapse when the metal stopped flowing. The Dutch East India Company used silver arbitrage between Europe and Asia as one of its core profit engines. Britain demonetized silver in the late 1800s and set in motion a century of suppression that ended with the commodity entering its current role as the industrial metal of the 21st century's technological revolution. The pattern isn't identical, but the physics of supply and demand has never been repealed. Here's what I want you to watch for in the next 48 hours and over the next 2 to 3 weeks. Keep your eye on CME registered inventory updates at cmegroup.com, specifically whether registered silver continues to drain or whether eligible to registered conversions start to cushion the pool. Watch the March delivery report as it accumulates through mid-month. If actual physical takedown approaches 50 to 60 million ounces for March, the stress indicators light up at levels without modern precedent. Watch the US dollar index, DXY, around the 97 to 99 range. A retreat from 98 is dollar negative and silver positive. Watch the Fed messaging around the rate path for mid-2026, and watch the geopolitical headlines, specifically the US-Iran situation and any return of tariff discussions on critical minerals, because JP Morgan's own research identified that as the potential trigger for the next physical squeeze. One more thing. CoinCodex's algorithmic models, as of March 5th, were forecasting silver could fall to $73.17 by March 11th. That's a bearish near-term call. Others project silver reaching $223 by year-end 2026. I'm not in the business of price prediction. I'm in the business of showing you data and letting you draw conclusions. What I will say is this. If you're positioned in silver in any form, you need to understand the structural conditions I've laid out today, because the next move, whenever it comes, is likely to be sharp. These markets don't drift sideways forever when the physical supply is under this kind of pressure. So here we are, $82.26. That number means either one of two things. It's the end of a historic bull run, killed by a hawkish Fed nomination and a margin hike that finally shook out the last of the leveraged longs, or it is, as the COMEX delivery data, the inventory figures, the lease rates, the industrial demand profile, and the JP Morgan research all suggest, a temporary paper suppression event in the middle of a structural deficit story that hasn't resolved. I've shown you the CME data. I've shown you the JP Morgan research. I've shown you the lease rate history. I've shown you the Shanghai inventory drawdown. I've shown you the delivery records. Every one of those sources is publicly verifiable. I'm not asking you to trust me. I'm asking you to look at the numbers. The people who understood these dynamics in January 2026 watched silver run from $32 a year ago all the way to $121. The people who saw the crash coming saw the margin hike and ran. Which group understands the structural picture better? That's the question you're answering right now. This is not financial advice. Do your own research. Consult a qualified financial advisor before making any investment decisions. But I will tell you what I think the data shows, clearly and without hedging. We are in the middle of a physical silver story that the paper market has temporarily interrupted. Whether the next 48 hours are the beginning of the next leg or just more volatility, that's something only time will tell. But the structural argument hasn't changed, and neither has the COMEX inventory chart. Drop a comment and tell me, are you watching the March COMEX delivery data, or is the paper price the only thing on your radar right now? I genuinely want to know how you're approaching this, because the way people answer that question tells me a lot about how the community is positioned. I read every comment. Your perspective shapes what I cover next. If you haven't subscribed yet, and 3 out of 4 of you haven't, now's a good time. Hit the bell too, if you want the next update the moment this March delivery data hits, because things could move fast. I'll have a follow-up video the moment the mid-month delivery numbers come in. And while you're here, check out the video I put together on the gold to silver ratio and what historically extreme readings have meant for silver prices over the last 45 years. That's the next piece of this puzzle. I'll link it right here. Stay sharp. This market rewards preparation, not reaction.